Good morning. I'm Ken Leon, Director of Equity Research at CFRA, and thank you for joining us in terms of what I think is going to be a very interesting webinar, Washington Casts a Shadow on the Stock Market. Next slide, please. First, a disclaimer, this presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. Next slide. With me today and very excited for this webinar. It's our first since the purchase of Washington Analysis. We have, of course, Sam Stovall, our Chief Investment Strategist, very often on these webinars. Ryan Schoen, who's President and CEO and Financial Service Analyst from Washington Analysis, and Joe Lieber, who's the Director of Research, the Political Analysis, and boy, we have a lot to talk about as it relates to Washington. Washington Analysis is a world-class, well-known research firm, one of the top three in terms of institutional investors, All-America team on the institutional side, and they have a large team that's looked upon for their expertise, as Ryan and Joe will share today, but others covering different areas of policy or sectors in the market. So this is going to be a lot of fun today. Next slide, please. So when you look holistically at CFRA, and we're not going to go back to 1927 for the S&P legacy research, but CFRA has been growing organically and also cobbling or acquiring excellent research franchises. First, back in October 2016, where CFRA acquired the S&P research. Second, First Bridge Data, which gave us a world-class expertise and database for ETFs, and quite busy in 2021, first with the acquisition of Lowry Research, another world-class team in terms of doing market technical research. And then, of course, as mentioned, Washington Analysis. So it gives us enormous capabilities, first in each of the disciplines that we do. I'm on the team related to fundamental research, but when you pull these together, it gives us a great opportunity to collaborate, to leverage data and analytics, and also use that for coming up with insights that drives performance for our clients. Next slide, please. We like to talk about the engine or the flywheel from each of these research disciplines, but for this audience in wealth, for fundamental research, we actually capture it as well, both from a top-down and a bottom-up level. Sam leads as the Chief Investment Strategist and distills with our sector analysts market strategy, sector weightings. We also have that work with our research, both in our 1,500 global companies that we cover on a qualitative basis, but our analysts are experts on their industries. And then also, besides company and industry research, we have ETF and mutual fund research. Of course, we also offer on Market Scope Advisor model portfolios, and where we are really best in class is taking this flywheel and data and analytics and coming up with timely thematic research, really idea generation. And that has been something highly looked at by our customers because it's a great way to think about your portfolios. The forensic team, which I didn't mention, which is the original part of CFRA, also has a great reputation both in forensic accounting, legal, and other insights. And we have found that useful in collaboration across research, but also for our clients when they do those very deep dives, you know, in terms of accounting, not necessarily finding the nuggets when managements want to tell you one thing and our great forensic team is telling you what the numbers say. So with that, Nicole, let's move to the next slide. And we're going to kick this off with Sam Stovall, our Chief Investment Strategist. Good morning, Sam.
Well, good morning, Ken. Good morning, everybody. Thanks for tuning in. What I'm going to do today is to give sort of a 10,000-foot backdrop as to what usually happens to the market during midterm election years, and then talk about the specific catalysts that we are experiencing now, and in a sense, how real-time events are actually confirming what usually happens in a fairly challenging second year of a president's term in office. If we go to the first slide, what we'll see is that history basically says that 2022 could be a good year, but probably not a great one. And reasons are that, interestingly enough, last year we were up almost 27% for the S&P 500, and in the 20 times that the S&P was up by 20% or more in one year, it was higher by a little more than 10% in the second year. But then if you overlay the fact that this is the second year of a president's term in office, it's also the third year of a bull market, both of which are the weakest years of any of these cycles, then it brings down what is the total price appreciation potential for 2022. In fact, we're looking for a year-end number of 5024 for the S&P 500, which equates to a mid to low single-digit price appreciation. What's also interesting is that each one of these post 20% years experienced declines. And usually these declines, which were as much as, or I should say on average around 11%, occurred in the first quarter of the year. And that's exactly what we are experiencing right now from peak to trough on a closing basis. The S&P has been off by about 12%. Also, we see the market being vulnerable to this sell-off because we started the year with elevated valuations. Now, of course, what's bringing it into real time is that the markets this year were staggered by the 1-2 punch from Powell and Putin. And what we have realized is that with the prospect of the Fed raising interest rates and with the 10-year yield itself climbing, we find again that negative correlations exist between the S&P 500 PE ratios and these rising 10-year yields, to the point where, not surprisingly, we have seen and undergone PE contraction for the markets. From a geopolitical perspective, you know, the question still outstanding is today Ukraine, tomorrow Taiwan. So obviously Ryan and Joe will be speaking more about that. But just in terms of the volatility, what we're experiencing now is fairly normal. Elevated volatility and variability of quarterly returns is the norm in midterm election years. And if history follows suit, and again, Ryan and Joe will tell us whether they think it will, first-year Democrats have historically lost 26 seats in the House and 4 seats in the Senate, which could either make for a split Congress or a unified Congress under the Republicans. Let's go to the next slide to briefly look at a chart that shows the market's returns following surprise military and terrorist actions since World War II. On average, what you can see is the price change as well as the frequency with which the market rose in that period. And obviously, on the very first day of that surprise, the market was up only 1 out of 3 times on average. So not surprisingly, the surprise pushed share prices lower. But then as you see that the frequency of advance improved after 30 days, 60 days, 90 days. Of course, there are exceptions to every rule. I highlighted in blue Iraq's invasion of Kuwait, the Yom Kippur War, which triggered OPEC's turning off of the oil spigot, the Suez Crisis and Hungarian uprising of 1956. So these events either were triggered or were coincident with bear markets or sharp declines in the S&P 500. So it's hard to say what actually triggered the other, but more times than not, it represents an opportunity to buy rather than bail. Let's take a look at the next slide. You can see the magnitude with which the market has risen or fallen in midterm election years and the actual standard deviation of returns. I highlighted in blue in the left-hand grouping the average price percent changes, that the second and third quarters are typically the weakest, down 1.8% and 0.5% on average, for making the full year up less than 5%, which is the worst of all 4 years. Continuing with the blue on the right-hand side, we see that the second and third quarters have seen a significant increase in volatility when compared with the other quarters of the presidential cycle. And actually, for the full year, about 40% more in the second year than compared with the average for the other 3 years. But then I highlight in green to show that once this uncertainty has passed, then the market tends to take off because the uncertainty has been lifted, and now the market can go back to taking advantage of whatever price distortions presented themselves. So fourth quarter up 6.1, first quarter of next year up 7.5, second quarter up 4.2, and you can see also that the variability and the volatility come down quite dramatically. So that gives us something to look forward to in the year ahead. If we take a look at the next slide, as I mentioned, there is a possibility of us going to a Democratic president, but a Republican Congress entirely, or a split Congress. And what is interesting is that either one of these scenarios are among the strongest average returns. The Democratic president with a Republican Congress, as seen in the middle grouping called Unified Congress, we saw a 13% average price increase. This has happened 10 times since World War II. And the FOA, or frequency of advance, the number of times that it went up in price for that calendar year, was 6 out of those 10 times. Even better is if we have a split Congress. I guess gridlock is good, because we ended up with a 13.6% average return, and the market went up 3 of those 4 times. So this is enough of the history lesson. Let's go to the next slide to see what our economists and analysts are predicting. Well, not surprisingly, we're going to see a slowdown in S&P 500 earnings in 2022, with the projected gain now being 6.6% versus the 47% surge that we enjoyed in calendar year 2021. Revenues up more than 15% last year, but should be up nicely, up 8% this year. Real GDP growth, while it certainly has come down from the early estimate of about 4.5+%, now it is at 4% for 2022. There is an old adage that for every $10 increase in the price of oil, it takes off 20 basis points of real GDP. So the longer oil prices stay elevated, the more pressure we could see on GDP growth. Headline CPI, unfortunately, is likely to remain elevated through much of this year, with the average in the fourth quarter being just a shade below 5% from the 7.5 that we are anticipating to be released in the February data. Not surprisingly, the Fed funds rate is expected to go up. We're looking for 5 rate increases this year, 3 before mid-year, and then 2 more for good measure in the second half, which should help push the 10-year yield up to 2.3% in the fourth quarter on average in the end of this year. Major dollar index will likely strengthen, and also oil prices, we think, are going to remain elevated for quite some time. So where does the market stand right now? Let's take a look at the next slide. This simply looks at the rolling 40-week or 200-day relative strength for the 11 sectors within the indices, meaning the large cap, mid cap, small cap US stocks, as well as the Euro 350 and Asia Pacific. The top 4 are shaded in green. The bottom 4 are shaded in red. So it's basically the old adage of let your winners ride, but cut your losers short. It says that if you owned in equal proportion those 4 sectors that were ranked plus at the end of each month and then reevaluated at the end of each successive month, the next grouping shows that 3-year compound annual growth rates showed an outperformance by using this technique over the last 3 years, whereas the top 4 sectors for the equal weight 500 were up 17.8 versus 14.1 for the benchmark, and the bottom four sectors were up only 6.7%. And it's being fairly consistent for all of these indices except the Euro 350 thus far in 2022. So right now, basically, the market is saying we're worried about higher earnings, higher interest rates, and the PE compression that we are likely to witness as a result. So not surprisingly, that communication services and consumer discretionary have been experiencing some near-term weakness, yet energy, financials, tech, and real estate, remember, on an equal weighted basis, have actually held up quite well. So something to consider going forward. My final slide, if we will, the summary basically says that this market is undergoing a typical tumble following 20% plus years. And what's triggering that this time around are the challenges that include Russia's invasion of Ukraine, the higher than and longer lasting inflation than anticipated, and what is likely to occur with the Fed's monetary policy in the year ahead. Some encouragement is coming from the continued expectation that GDP and earnings will be on the ascent, but don't be surprised if we continue to see weakness and volatility being fairly elevated in second and third quarters of this sophomore slump, or second year of a president's term in office. But then remember that good times tend to follow bad times, and that the market does tend to take off in Q4 of midterm election years. So with that, enough of the summary. Let me now turn it over to Ryan Schoen, who will talk to us about Washington analysis.
Terrific. Thank you, Sam. A lot of terrific information in those slides. I'm going to pivot a little bit and drill down on one of the, I think the first of the two 1-2 punches that Sam highlighted, the Federal Reserve and the outlook for activity out of that body. Nicole, could we shift to the next slide, please? So right now, an issue that we don't think gets as much attention as arguably it should. We've got a Federal Reserve Board that is limping along with effectively only 4 of the 7 seats filled. We have an administration, a White House that has nominated a whole slate of candidates to fill out that body, but they have run into resistance in the Senate. Every governor at the Federal Reserve has to be confirmed by the Senate. The 50-50 dynamic in the Senate has led to challenges in that regard. So Chair Jay Powell is actually operating as, in effect, an acting chair right now, chair pro tempore. He's awaiting Senate confirmation for his second chair term. Lael Brainerd, current governor, is also awaiting Senate confirmation to become vice chair. Mickey Bowman is in place and confirmed. Chris Waller in place and confirmed. And then we've got 3 additional nominees to round out the board, the most controversial of which is Sarah Bloom Raskin, a name that some folks on this call may recognize. Her husband is a prominent member of the House of Representatives, a Democrat who really led the charge in the Trump impeachment saga several years ago. And then we've got Lisa Cook, a Michigan State University economist, and Philip Jefferson, Davidson College economist as well. Right now, the Senate Banking Committee has held hearings on all of these pending nominees, but we have a 12-12 evenly divided Senate Banking Committee with a committee rule that effectively says you need to have a majority of the members of the committee present in order to have a quorum. So in order to have a vote, a confirmation vote to process and move forward these nominations, Republicans need to actually show up, and there needs to be a vote convened by committee leadership, namely committee chair Sherrod Brown, Democrat from Ohio. Right now, there's a standoff happening between Democrats and Republicans in this committee that can basically be resolved in effect one of 3 ways. The chair, Sherrod Brown, could unbundle these nominees that are pending, the most controversial of which, as I said, is Sarah Bloom Raskin. Republicans are basically taking the stance right now that if Raskin is put aside and the other nominees are brought for votes, they'll support them. We don't see any signals that Brown is actually going down this path. He's holding strong thus far. Another alternative here could be that Republicans simply concede and swallow effectively all of these nominations in their current form. Again, no signs of that happening to date. The third possibility here, and the one that we think is actually likely to play out eventually, will be that Senate Democratic leadership will change the committee quorum rules to effectively lower the threshold needed in order to meet a quorum and convene votes. That takes time. That takes prioritizing that step on the part of Senate Democratic leadership in what is, even as Sam alluded to, and as Joe Lieber will get into in just a moment, a very contentious and crowded policy agenda in the Congress. Next slide, please, Nicole. So what does all this mean? There are somewhat obvious monetary policy considerations here. You have an acting Fed chair. You've got an incomplete board of governors at the highest level. I think that certainly gives pause to each governor in terms of how they think about monetary policy right now, as if they didn't have enough on their mind in terms of geopolitical risks, domestic economic concerns, inflation. They have a limited body, an incomplete bench, effectively, that makes it quite literally impossible to have a consensus view across 7 governors. There aren't 7 governors today. Separately, from a regulatory standpoint, big decisions in terms of changing or amping up the pressure on large banks, for example, through the CCAR stress test process. That's something that's very difficult to do without having more bodies in the room, more staff in the room, in order to make those big sizable changes. Banking regulation, of course, going into this Biden administration, I think there was a fairly well understood, widely held view that Democrats historically have had a more antagonistic, heavy-handed approach to regulation. That's something that, again, is just an agenda work stream that's difficult to execute on without having a full bench. And then shifting gears a bit, taking that a step further, we have a number of, we have a whole block of the Democratic Party, the progressive wing of the party, that wants to see the Fed more actively engaged in the climate change debate, with the likes of Elizabeth Warren and others who are really loudly advocating for the Fed to engage in directing lending and capital flows away from dirty energy toward more clean energy initiatives and corners of the economy. And then also a digital dollar, cryptocurrencies, fintech more broadly is absolutely an area of focus for an increasingly large area of focus for all financial regulators, the Fed included. We anticipate that when Congress, when the Senate eventually right sizes these rules and gets these pending nominations through, which we do think is the eventual end game here, we think that you'll see the Fed really start to sink its teeth more aggressively into some of those issues, fintech more broadly, that is historically not within or has not been to date in the Fed's purview. So we sort of characterize all of this as an expansion of the regulatory perimeter. The Fed is very much looking at bank partnership models, the likes of a PayPal or Square or many others who are effectively accessing the banking system, the commercial banking system, through partnerships with typically much smaller institutions, insured depositories. And then again, I would extend this to the broader crypto conversation as well, which just today we're seeing Powell make more comments around and urging Congress to engage from a legislative standpoint. All of this, again, tricky to do on the part of the Fed with this incomplete bench. So I'll pass the baton to my colleague Joe here in just a moment. Is it significant if the midterms go, as Sam alluded to a moment ago, if we flip control here and we see Democrats lose one or both of the chambers in Congress, what avenues or what are the implications for the Fed and its actions and its ability to make decisions? Well, typically what we see in divided governments, regulators tend to take center stage. They become far more proactive when Congress is divided and the parties have a hard time passing legislation. And then even further, if we have a Republican Senate and a Republican House, which again, Joe will assign some probabilities here too in a moment, there are tools at Congress's disposal for checking regulatory actions. There is the Congressional Review Act, for example, that allows Congress a simple majority vote of both the House and the Senate to weigh in and effectively override, if they deem it appropriate, agency actions. So I think that's a conversation that, as we get into the back half of this first Biden term, I think it's going to become a far more salient check on what we see and hear out of the Federal Reserve. With that, I'll pass it over to my colleague, Joe Lieber, our Director of Research and Political Analyst at Washington Analysis.
Ryan, thanks a lot. I appreciate it. Again, thanks to everybody for joining us today. I'm going to try in this brief time that I have to cover three pretty big topics. One, the midterm elections, as Sam and Ryan have alluded to. Two, one of the marquee pieces of President Biden's agenda item, the BBB, the Build Back Better plan, or the revised Build Back Better plan, whatever they're going to be calling it these days, as was prominently mentioned, although not by name, in the State of the Union address. And then also kind of give our bottom line on, the most important, or one of the most important things facing investors today, and that is the Russia-Ukraine situation. So let me first start off, if I could, with the midterm elections, and if you can maybe just Nicole, there we go, move the slide over. Let me start by kind of giving a little bit of a where we are now with regard to President Biden and congressional polling data. It's not good for the president. It's not good for the Democrats. Right now, President Biden's overall approval rating, and these polls are 24, 48 hours old. They may have changed slightly. His overall approval rating is 41%. Just to give you some historical example, the worst presidential approval rating at this time in his first year was President Trump. He was at 38%. President Biden has the second worst approval rating since we've been taking polls, basically since World War II. I think maybe more importantly than his overall job approval rating is his approval rating on the economy. It's at 38%. I think inflation has a heck of a lot to do with this. Again, this one may be more important than the overall job approval rating. That is, those numbers are just really bad. His COVID approval rating, in my view, is worse than I would have anticipated at 46%. His foreign policy approval rating is at 38%. If Ukraine falls, I think that's got a potential to go down too. I think, we're probably not going to see much of a rally around the president with regard to the Ukrainian situation, since we're not fighting in Ukraine. But I think we could see a negative for President Biden here if, if Ukraine is lost to Russia under his watch. Then the generic congressional vote. This is a basic question that's asked periodically. If a Republican or Democrat, if the election were held today, would you vote for a Republican or Democrat? It doesn't mention anybody by name, doesn't mention your congressperson by name. Republicans have about a 5-point lead here. Just some historical information about this poll. For whatever reason, and pollsters are kind of perplexed as why, this poll tends to favor Democrats more than Republicans. And that would even be a Republican-leaning poll or a Democratic-leaning poll, meaning the pollster who does the polls. So I kind of always think to myself on these polls, add a couple points for the Republicans, maybe subtract a point for the Democrats. So the advantage for the Republicans is probably a little better than 46-41 is what I'm trying to get at. I included the direction of the country in here. It's terrible at 28%, believe we're on the right direction, 65 the wrong direction. I will say this though about this one, I wouldn't read too much into this. We've had a right direction, wrong track numbers similar to this for a few decades now. The American public is just not very happy with Washington. I think most of everyone knows that. Nicole, please, the next slide. And so how does that, how do those polls kind of result or imply what might happen to the congressional elections coming up on November 8th? Well, first of all, as you can see, the current makeup of the House is 222 Democrats, 211 Republicans. There's 2 vacancies. Those vacancies are from Republican-held seats, so maybe you could say there's 213 Republican-held seats. You need 218 to get a majority. So Republicans need anywhere from, call it, 5 to 7 seats to take the majority. It's one of the most narrow Congresses we've seen in history. Obviously, I think as everyone knows, The Senate's tied at 50-50. And then a couple of interesting data points. I think Sam touched on one of these. Since World War II, the incumbent party in the White House has lost an average of about 26 House seats and roughly a little less than 4 seats in the midterm election. The bad news for President Biden is in the Democrats is when the president's approval rating is below 50, and as I mentioned, Biden's is around 41 right now, the average loss in the House is 41 seats and a little more than 4 seats in the Senate. So I have a pretty high probability right now that the House is going to flip to the Republicans. I put it at something astronomical, at least astronomical from my view, 80 to 85% probability. I would have to think that some, interesting, jarring revelations from the January 6th commission are going to have to come out to stop this. The economy is going to have to dramatically improve. And when I say that, I mean inflation is going to have to dramatically improve. I just don't know what could happen between now and November 8th that would change the Democrats' situation enough to where they would retain the House. As things get better, the number of seats that Republicans pick up may slow down or may go lower, I should say. But I still think the Republicans win the House. Secondly, with regard to the Senate, I'm not nearly as confident on the Senate. There's a number of reasons for this. There's more Republicans retiring than Democrats. There's potentially more Republican seats at risk than Democratic seats. But given the environment right now, I put around a 60% probability that the Republicans will retake control of the Senate as well. And you can go to the next slide now, please, Nicole. And so with that, I want to just leave you with that. The one thing I will say is giving the 80-85% probability that the House flips, some of the risk premium in the marketplace or the uncertainty in the marketplace over the elections might dissipate sooner than expected or sooner than other previous midterm election cycles from a market standpoint, just given there's a high expectation that Republicans are probably going to win back. And then let me pivot to a revised Build Back Better plan. I think everyone's familiar with the Build Back Better plan. I'm not sure what the heck they're going to call it as they move forward. President Biden didn't even mention the word Build Back Better in his speech. That's probably partially because Joe Manchin has called the plan dead. But I think some remnants of the BBB, I have here odds remain about 50-50. We got some late news yesterday. Senator Manchin had some positive news out about the BBB and some of the provisions of the BBB. And so my odds are now a little higher than 50-50 that we get some type of BBB proposal done. The thing I would say is that the bill's probably going to be smaller than the $1.75 trillion that the House passed late last year, and will probably include things like most all of the green energy tax provisions. Manchin said yesterday or reiterated yesterday that he supports most of these green energy tax provisions. So I think from a sector standpoint, given that I think you're seeing some of the green energy companies pricing in a zero probability of a BBB getting done, I think you could see some positive news for that sector as we move forward. Most of the healthcare items will probably be in the revised edition that we saw from what we saw in the House. We'll see most of those probably will stay. There'll be a couple that will be done away with, and almost all of the tax hikes that were in the original House version, the 15% corporate minimum tax, the GILTI tax increases, et cetera, et cetera. Those are all, I think, most likely going to be in any kind of revised BBB. Manchin really didn't have a problem with those after the House passed them. In fact, he would like to see the corporate rate go beyond 21%. I don't necessarily think we're going to see that, but he would actually like to see more in tax increases. A couple of other points that might be of interest to you folks out there. The SALT deduction, I'm starting to believe that we may get nothing on the SALT deduction. If we get something on it, it's going to be very, very pared back from what the House proposed. Recall the House proposed increasing the SALT deduction from $10,000 to $80,000. I think it's going to be way dramatically scaled back, maybe 10 to 30, or maybe just left out of this plan completely. Manchin also wants deficit reduction. He mentioned yesterday that he wants the savings from the tax increases and the savings from the drug provisions that would be included in any BBB legislation. He wants half of that to go to green energy tax provisions, maybe some other small social programs, and the other half to go to deficit reduction. This could be the first real deficit reduction package that we've seen pass Congress since the Budget Control Act back in 2011. And then finally, my odds aren't extremely high on a BBB or a revised BBB plan passing. There have been a lot of questions that we get at Washington Analysis. There are a few expiring green energy tax provisions, namely the PTC and ITC for solar and for wind, and the R&D tax credit, of which the defense industry, pharma, high tech, biotech, et cetera, rely on. That has gone to a 5-year amortization as opposed to allowing companies to deduct their R&D expenses in the year they were taken. I'm kind of an outlier here, I believe. I think the consensus is among companies and among Wall Street analysts is that we will get what we call a tax extenders bill at the end of this year to fix the green energy tax provisions and fix, if you will, the R&D tax credit. I think that's unlikely. I think those things do make it into any BBB package, but are unlikely to be done on their own this year. And Nicole, if you could move to the next slide, please. And with that, let me kind of wrap it up before I hand it over to Ken for some questions about kind of our viewpoint on the Russian invasion of Ukraine, the terrible situation that's going on over there. We're looking at, you know, our end game that we think is a Ukraine that's going to be a puppet state of Russia. The west of Ukraine could very well be kind of this, you know, a little bit of a Wild West outpost where you have a lot of anti-Russian sentiment in the west, and you could see an insurgency out there, maybe in the whole country, but especially out in the west of Ukraine, you know, lasting for years and years and years. One of the other questions we get quite a bit from clients is you know, will we see Russia try to expand their aggressive behavior towards other countries other than Ukraine? Namely, maybe the previous Warsaw Pact countries, Poland, the Baltics, Hungary, Romania. We think it's unlikely that they will be attacked / invaded. We think that's very, very unlikely. Those countries are now part of NATO, and that would cause some grave concern among the U.S. if that happened. The one area we would be cautious about too is you may also see Russia and Belarus go into Moldova as well. So it may not just be Ukraine; it could be Moldova. Another question we get quite a bit is, are nuclear weapons likely to be used? That's a big concern, obviously, among market participants. And we do not believe that Putin is going to use nuclear weapons. Part of that reason is that this will be a war that's going to be confined just to Ukrainian and Russian troops. And then with regard to sanctions, you may have seen that late yesterday, the U.S. imposed technology sanctions on the energy sector. So no technology exports from the U.S. to Russia are going to be allowed. And we think what you could very well see, especially if things get bloodier in Ukraine, which we unfortunately expect will happen, is you could see continued ratcheting up of these energy sanctions. You know, first of all, we can see blocking of Russian energy companies from doing business with the United States. We could also see eventually you know, no Russian imports of oil from to the United States. We think you could see the same thing happening on the European front. Maybe not a complete ban on oil imports from Russia, but maybe a quota system on how much oil and gas they might import from Russia. The other thing I would say about these sanctions is it's our view right now that as long as the Ukrainian situation is the way it is, and if we do see a puppet government in Ukraine, the chances are these sanctions could last years. When Russia invaded Ukraine in 2014, those sanctions have been in place since 2014. And then finally, let me wrap it up. We have the potential for some Russian retaliation here. I think the biggest risk we see are cyber attacks on critical infrastructure. This would happen both in the EU and in the US. It could happen on our financial systems. It could happen on our, utilities, et cetera, but we expect to see some of those happening. I'm sure there have been some attempted already. And again, also we could see, as I mentioned earlier, some oil and gas export restraints into Europe from the Russians as well. That might be biting off their nose to spite the face, but that could be something we see as well. I think maybe the positive news, if there is some out of this from a market standpoint, is the Russian-Ukrainian situation. If Russia's going to go full board on this, there's probably a pretty good chance they can take the country fairly quickly, and this would get the situation out of the headlines. And with that, I'll wrap it up, and Ken, I'll hand it back over to you.
Thanks, Joe, and great insights from all, Joe, Ryan, Sam. I'm going to steer this back to the equity market, Sam, and noting 2022 is kind of a choppy year, weak Q2, Q3, and maybe stronger Q4. Sam, you look at a lot of measures, whether it's our fundamental research, relative strength, 200-day moving averages. Should investors wait or at least look to support levels before they get much more active in buying in the market, given it looks like Q4 is when we get the performance?
Well, we're at a inflection point right now, in my opinion, also pretty much confirmed by our technical analysis arm called Lowry Research, where we are looking to see whether the 4,300 level on the S&P 500, which is a recent support level that the market bounced off of twice, if that is going to hold. And if so, well, then obviously we're looking for higher highs and higher lows as the market persists. If, however, we find that that 4,300 level does not hold, then I think we will have breached the neckline of a head and shoulders pattern. Plus, if we look to a Fibonacci retracement level, both of those indicators would be pointing to 3,800 on the S&P 500. So I think basically, the feeling is that we could see more downside, but we're going to take a wait and see attitude right now. Another thought, however, is take advantage of some of these very low prices in terms of looking at stocks that offer nice dividend yields, but are also sport high quality rankings. What I mean by that is these are companies that are ranked 4 or 5 stars by CFRA analysts, yield 3.25% or higher, or have an S&P quality rank of B+ or better. And you come up with some names like Amgen, like Blackstone, ConAgra, Kraft Heinz, OneOak, Pfizer, Philip Morris, and even Whirlpool, just to name a few. So I would really yield to temptation in some ways and start nibbling on these high quality, high yielding stocks.
Yeah, it makes sense, especially if we're going to get single digit returns. Dividends is a great way to get total return. Sam, another question I have for you is you are widely followed, one of the best in terms of sector weightings, kind of. So for our investors looking tactically, do you follow the seasonal rotation and look at that on an absolute basis, or do you tweak it a little bit, perhaps because of the sophomore year of the presidential cycle? And just share with everyone what exactly is the sector rotation you do.
Sure. Well, there's the old saying of sell in May and go away. And my research have found, no, you're actually better off rotating than you are retreating. Meaning if the market tends to do better in November through April, but is more cautious May through October, we'll then respect that, acknowledge that, and realize that we are going to typically see some of the sectors do better in the November through April period, and the more defensive areas do better May through October. And that is especially pronounced in midterm election years, because in that May through October period, while the defensive sectors of healthcare and consumer staples have risen by an average of about 5% going back to 1990, the market itself has declined about 3.5% on average. Of course, history is a great guide. It's never gospel. So look at this as a starting point. And then, as I showed earlier in the 200-day relative strength indicators for the sectors, sometimes you might have to tweak things a little bit. But I do believe that seasonal rotation is something that should not be ignored.
Shifting gears here, Ryan, and we're going to be moving to Fed watching very quickly with the March 16th FOMC. How much of an issue is this with having seats where they're nominated but they're not approved yet by the Senate? I mean, is this a big deal, or the Fed just continues to able to do what they do so well?
No, that's a terrific question, Ken, and you know, I'm not sure that there's a really clear black and white answer to that. You know, having 4 governors instead of 7, you know, you're really ramping up the accountability and responsibility on those 4 relative to having 3 additional colleagues that can sort of share the blame or the credit for whatever the Fed does. You know, I would say that inflation is certainly on the tip of everyone's tongue in Washington, alongside you know, Russia, Ukraine, and the potential for contagion in other geopolitical sort of venues and around the globe. I think it makes it that much harder for the Fed to make decisions, bold decisions in particular, whether you're talking monetary or regulatory policy.
Yeah, so on the other side, of course, is bank regulation and the lightning rod, Sarah Bloom Raskin. What's your read here? You know, is it either from past views or comments from Senator Sherrod Brown, or possibly stoking the Fed on the regulatory side to be a little bit more political or friendly to renewable energy and sway banks on their capital, not to go into areas that are not as politically palatable, like fossil fuels? Is there a, you know, more intense political heat here, or maybe the Biden administration just picked the wrong name and they'll get someone maybe still on that side of views, but not as controversial?
Another good question, Ken. I mean, I think maybe taking that in reverse order, you know, this administration has certainly, when it comes to financial regulatory nominations, they've been very bold. They have really done a lot. They've put a lot of names on the table that have come squarely out of the progressive end of the party. You know, the most prominent or sort of stark of those examples is Saul Amarova, who's nominated to run the office of the comptroller of the currency. You know, the listeners are probably somewhat familiar with that saga. She was a Moscow State University grad, had very, very strong views around climate change and the role of the Fed and central banks more broadly in intervening and directing capital in different directions. So I think that this administration, I think we can say now, they miscalculated on a few of those picks, Amarova probably being at the top of that list. But I think, you know, you take a step back, I think that this is the world that we're in for certainly the remainder of this Biden term. We're going to see a Fed that is, again, just far more focused on issues that we haven't seen them focused on in the past. You mentioned climate, that's a big one. I mentioned crypto earlier, and sort of emerging financial technology models that, again, if you look at the facts, there's not, in many instances here, there's not clear Federal Reserve jurisdiction to intervene or opine, but they're doing it. You know, they've stuck their toe in the water thus far, and I suspect we'll see a few more toes stuck in the water over the next couple of years.
So before I give one more to Ryan and then Joe, for those who have questions, you can use your chat box to come in with your questions. Ryan, you know, Joe mentioned sanctions in Russia since 2014, but it seems that, you know, in U.S. Treasury with Janet Yellen, who's no lightweight, that foreign assets control department's going to have a very significant role here. And is that an area that you think you're going to be looking at, or investors need to focus on more, given that the Russia-Ukraine crisis is just not going to be over short term?
The short answer is yes. You know, you look at the Treasury Department, there are 2 very relevant divisions under the hood at Treasury that are relevant here. You mentioned OFAC, which is basically in charge of all things sanctions related, as you said. And then we also have FinCEN, tasked with all Bank Secrecy Act and anti-money laundering jurisdiction as well. Those two departments we have seen over recent recent history when there are geopolitical dust-ups or particular nation states that run afoul of what the U.S. wants to see globally. We've seen them really sit up straighter and take much more aggressive postures. So, long-winded way of saying yes. Those two divisions in particular under the Treasury Department, we anticipate to be far more active over the next several years. And again, we're already seeing some of that right now.
So Joe, midterm elections, and to your probability so high of a Republican Congress, where does the Biden administration or President Biden go from there? Do they still try to excite the base, or do they try to go to the center, the moderate, be more pragmatic for Biden, like Bill Clinton did? What's your take on that, Joe?
So Ken, if we look at the State of the Union address a couple of days ago, we see an attempt, at least, by the Biden administration to move to the center. I'll give you 2 points from that speech that kind of, I think, show that, or maybe 3 points. One is, he was pretty emphatic about his emphasis on we are not going to defund the police, but we are in fact going to fund the police, right? And I think that probably did not go over very well with his progressive colleagues and the progressive wing of the Democratic Party. He also gave, I think, short shrift to green energy in his speech. I was surprised at how little time he spent on green energy provisions in the speech. That might partially be a reason because oil prices are so darn high. And some of the American public might see an emphasis on green energy as not trying to emphasize enough oil production, et cetera, trying to get oil prices down. So that is another aspect of his speech that I think was a little bit surprising to me. I'm not sure, you didn't ask this part of the question, I'm not sure if it's a smart move on the Biden administration or not. We're not going to get really any legislation done this year with the exception of the BBB, if that gets done, or a revised BBB. There's a China competition bill that he mentioned on Tuesday night. The biggest components, the CHIP Act, that would provide up to about $52 billion for chip companies, semiconductor companies, to build chip fabrication plants here in the United States. That piece of legislation is probably the only other one going to go through. There's no other bipartisan piece of legislation that are going to go through, with exception of passing the budget here. That's it. And so moving to the center, I'm not sure is a great idea. He's going to have to try to get his base psyched up for these midterm elections, And I don't think Tuesday did that. I think if anything, Tuesday probably upset his base. And those are the people that you really need to show up in November.
So here's a 2-part question for you. So you got until the November midterm elections. So is Pelosi and Schumer really are they going to be able to affect legislation while we're all also not distracted, but focus on the crisis in Ukraine?
Yeah, I mean, I'd like to say that, politicians in Washington can walk and chew gum at the same time. It just sometimes when they're walking, they stumble, and when they're chewing their gum, they may bite their upper lip or something. They can do it. It's possible, but it's no doubt that the Ukraine-Russia issue is a distraction. There's no doubt. I think folks on this call probably know that we have a continuing resolution that funds the federal government that expires next Friday. It's been my expectation that they'll come to an agreement on something by next Friday. I'm starting to think that there might be a chance we have to, pass another CR for another week or so. And part of the reason is the distraction over this issue, over Ukraine and Russia. It does suck a lot of the oxygen out of the room. So, Ken, that's probably one reason why I don't think passing. It's one reason that my odds on a revised BBB, even in light of yesterday's comments from Manchin late in the day, that I think were positive. I just don't know when we're going to see that BBB pivot. Maybe we'll see it after we give some funding to Ukraine, over the Russian invasion, after we pass the appropriation bills and fund the government through the fiscal year. And of course, one thing we haven't even mentioned here is once we confirm the Supreme Court nominee. That puts us probably in about the April timeframe. And if I was an investor, I would be looking at the April timeframe as a time to see if we're going to make movement on the BBB. That's when I'll be looking at it. If we don't start making movement on the BBB by mid-April, I probably will take my odds back down again unless there's some good reason for that not occurring.
And on BBB, it's clearly Senator Joe Manchin. And do you think it'll come through? So there is legislation, or, you know, time will tell.
So I've been an outlier on this. I look at Manchin's comments throughout the months, and he's been in favor of a few things, always. He doesn't mind the $1.75 trillion price tag. He's in favor of most all of the green energy stuff. There's some stuff on EVs he doesn't want to keep in there, but he's, for the most part, on almost all of the green energy stuff, he's fine with it. Yep, I can pass that. On much of the healthcare stuff, the really important stuff on the healthcare front, there's a couple things he doesn't like. The expansion of Medicare to include hearing aids, he doesn't like that. But everything else, he's pretty much on board on. And there's some things that don't really have an effect on the markets, like funding of pre-K education and some childcare stuff that he also supports. So I've always thought, as long as Senator Schumer and or Senator Biden are willing to go to Manchin and say, here's the deal, this is all you've been saying for the last few months that you're willing to support, here it is, can you support this? And I've thought that it needs to be Biden and or Schumer that are the ones that need to approach Manchin. They've been seeming to wait for Manchin to come to them. They're the ones that really want this bill to happen. Manchin's, you know, he'll support it, but it's not something that he's, you know, all that excited about. And one other thing I'll just mention real quick is Senator Schumer has been acting a little scared since the first of the year, or since the end of last year. There have been rumors and talk that he might face a primary challenge from the left. There had been talk early last year about, you know, AOC possibly challenging. I don't think that's going to happen, but, you know, he may be a little nervous about things that are going on his left wing. Just keep in mind the filing deadline in the state of New York for running for office there is April 7th. That kind of coincides probably when we'll get the Supreme Court nominee voted upon, when the congressional calendar in the Senate will open up. And I think if we see that Senator Schumer is not facing a real credible threat from the left, and we haven't seen one file yet, and April 7th comes and go, he might feel more comfortable about submitting, or at least proposing to Senator Manchin, a really, you know, scaled back BBB, something along the lines I've mentioned, and start to try to move that through in the April, May, June time.
Great. Thanks, Joe. And Nicole, if we can go to the next slide. And as we're doing that, one of Joe's slides, not for today's discussion, but you mentioned the Republic of Moldova. Looking it up, they do not have any, by constitution, armed forces. They have neutrality in their constitution, and they have no plans to join NATO. So hopefully they stay out of harm's way. I really want to thank everyone for joining us today, and our presenters that provided phenomenal insight about the markets and about Washington. Sam, Ryan, Joe, thank you so much. Nicole, if we can go to the next slide. Obviously, there's so much more here versus what we were able to do on the webinar. You can visit MarketScope Advisor to get more of Sam's insights, or the research team for fundamental research, visiting https advisormarketscope.com, or certainly reach out to CFRA. Likewise, for Washington analysis, you can take a look at the press release on the announcement of the transaction, and certainly reach out to below here to gain more information or subscription to Washington analysis. Most of all, thank you for spending some of your valuable time with us. Please be safe and healthy, and we'll speak to you soon.